So now we're going to talk for a little bit about the types of tools that are available to us in the education planning world. So we've got grants, savings and investments, loans, tax deductions and credits, and income gifting. We'll start with grants. So as I mentioned just a bit ago, that there are two types of grants basically. There are need-based grants and there are merit-based grants. So the need-based, if I go back to that needs analysis, the equation, the type 2 family, that the Smiths, if you'll recall, they had about a $3,000 need. It's very likely that they'd be eligible for some grants. Now, as far as the actual formula and how that happens, you know, that's a very detailed process and it's a very complex process, and so I can't speak specifically to it because it would take a long time and it would be very confusing, and nobody wants to listen to that. But it's likely they would be good candidates for receiving some sort of grant money. Now, it wouldn't be any more than the $3,000, but you know, $1,000 here, a couple $1,000 there, with some of the other tools that we're going to talk about in a minute, that can definitely help. So with regard to the merit-based grants, this is where the engaged student comes in, and they can compete based on either their skill. It could be, you know, an athletic skill, or some, you know, they're very very bright and have, you know, a big future in, you know, I don't know, developing a cure for cancer or something. In any case, there's a number of places that you can go to look for merit-based aid, and as I mentioned earlier, I think it was fin.aid.org is the website that is kind of a national repository for grants, merit-based grants that are out there. But also the colleges themselves or the university themselves, they have a number of grants and scholarships that are awarded on a competitive basis. For example, I've been working with CSU Sacramento, the College of Business, for the last year and trying to bring an undergraduate degree, financial planning degree program on campus, and I'm very excited to mention, just a quick side note, that this fall of 2012, they'll be offering an undergraduate degree in financial planning for the first time. Very excited about that. But related to that, we had to get some sponsors for the program, and the sponsors are offering significant grants, anywhere from $2,000 to $10,000 a year for that very specific degree program. And so checking with the financial aid office of whatever school your student might be attending is very worthwhile, because they'll be able to give you information about the different types of grants or competitive scholarships that are available. So you can look anywhere. A lot of big employers. I know we have a couple of Intel employees on the call today, and Intel, I'm fairly certain they have a number of grants that are available as well. So with regard to savings and investments, we've got, these are the typical tools or types of accounts that you can open. We've got the 529 savings plan and the 529 prepaid tuition plan. The main difference there is that one, you're locked into a specific school, that's the prepaid tuition plan, whereas the 529 savings account, you have a lot more flexibility in terms of what school you want to go to. When you put the money into these accounts, you don't get a tax deduction or anything, but any growth, appreciation in the value of the account, when you take it out, there's no tax that will be paid on that growth, so long as it's spent on qualified education expenses. So on the Coverdale, what's nice about the Coverdale is that You can use money in that account for primary education. It doesn't need to be on post high school expenses. Whereas the 529 plan, that's only eligible for post high school type of education, and the Coverdale can be used for high school or private school in the primary education. Savings bonds, typically we think about the series, the double E series, and that is the similar to the 529 plans, that if the proceeds are used for qualified educational expenses, then there's no tax that will be paid on the appreciation. So the Roth IRA, that is one of the tools that probably, if I did have to pick a favorite, it would be the Roth IRA, and that is simply because when you put the money in to that type of an account, you don't get a tax break in that year, but any growth and appreciation is not taxed so long as you meet some rules. So this Roth IRA is generally a retirement, an individual retirement account is what the IRA stands for. However, there are provisions that if you take the money out and spend it on the qualified educational expenses, that's one of the permitted uses for taking the money out of that. So, and then of course we have taxable savings accounts that you can use. What I've got here, it's a terrible slide, but it's wonderful information. It's terrible in the context of this kind of plan, in that there's a lot of detailed information. But I wanted to put it up here in case anybody wanted to come back later and look at it. But what it does is it lays out the pros and cons of the various college saving plans that are available, and some important information. I'll also have this up on our website on that education funding plan page by the end of the day. So this is generally where we get a lot of questions. I'm going to pause for a minute and see, Jeanette, do we have anybody who has questions, or I'll maybe just take kind of a minute to pause and see if anybody wants to ask any questions.
It doesn't look like we have any questions from people attending. However, I actually have a question.
Okay.
On the student resources, I know going back to what's included, you were saying that if the student has a savings account in their name, that's calculated into the cost.
Yes.
Now, what about a checking account in their name?
Yep.
Same thing?
Yep.
Okay.
Yep. Yeah, anything that's in the name of the student, whether it be savings account, bonds, investments, checking account, if it's going to show up on the reports that the financial aid office use, and I believe they pull them by Social Security number, then they're gonna look at that. So yes.
Okay, great. Thank you.
You bet.
And right now, no one else has any other questions at the moment, so it looks like we can move forward.
Okay, good. So I'm going to move into loans and talking about loans a little bit. There are, one thing that I'll just say about loans in general, there are federally subsidized loans, and then there are non-federally subsidized loans, and I would strongly encourage everyone to stay away from the non-federal loans. They don't have the protections. They've often, I've heard nightmares about that being a predatory lending environment, much like what we saw in the mortgage lending environment, a few years back, that the terms and the rates can be very, very punitive for the borrowers. And so with that in mind, I would strongly encourage anybody to stick with federal loans. So the three types of loans that are federally